Yes, watu wamefika. So if there's anyone who you know that was on the way joining, please let me know, let them know that we have already started so that we can get started together. Are we ready for my panel? Maybe as we get started, you can tell us where you are joining us from and probably what is your expectation for tonight so that we set the tone very high. I am promising you a very, very interactive session and we are going to all enjoy. Are you ready for my webinars? You can show me by pressing those emojis on Zoom and those other platforms that you're joining us from so that I know that we are ready to welcome the panel. We are going to have our session in two parts. The first part, we are going to look at the market outlook, where we have been this year and what we are doing now, and what is the outlook of the market in the coming days. And after that, we will have our executive, the co-founders themselves, come and unpack these numbers and what they mean to us as investors. Are you ready to get started? To start us, we will start with the gentleman on my immediate right here. And I want you to introduce yourself first, and then we will get started we go straight to the questions. Karibu sana.
Thank you, John. Hello, ladies and gentlemen. Welcome. My name is Paul Ouko. I'm the dealer and the market analyst. Yes, the macro market analyst.
Thank you so much, Paul. Asante sana.
Good evening, everyone. My name is Victoria Kioko. I'm a portfolio manager at Avocap.
Thank you so much, Victoria.
All right, good evening, everyone. My name is Howie Abonji. I'm the global markets analyst.
Thank you. You can already tell from the titles that we are loaded and we are ready for you. Are you ready for us? I think we get started right into it. Paul, we have seen this year, from last year, interest rates going down. From the highs of 17%, going down all the way to right now, bonds are going for below 13%. And at the same time, we have seen an increase in activities in the fixed income space. In the equities market. The shares market has become a bit more vibrant. And so I want you to tell us tonight, do we have a relationship between the rates going down and an increase in activities in the equities market? And where are the opportunities for investors in such an environment?
Absolutely, John. And to answer your question, maybe I'll start by painting a brief macro picture. You see, over the past 1 year, we've seen the local currency, the Kenya shillings, stabilizing majorly against the major foreign currencies, most notably the dollar, whereby we've seen Kenya shillings exchanging at a rate of around 129 shillings and 24 cents. Also, we've seen the Central Bank of Kenya keen on ramping up the foreign exchange rates, whereby we've seen the foreign exchange reserves standing at a level of 5.3 months of income cover. This is higher than the statutory requirement of 4 months of import cover. And also over the same period, we've also seen the inflation rate also stabilizing well below the targeted range of between 2.5% and 7.5%, which as per today is around 4.6%. So all these three factors has led to Central Bank of Kenya essentially cutting the lending rates and from time to time over the past 12 months. And as these lending rates go down, we see also the yield on government securities go down. So as the yield on government securities go down, like most notably the treasury bonds and treasury bills, these treasury bills and treasury bonds, they have an inverse relationship, their prices, with the lending rates. So as the lending rates go down and the yields go down, the pricing of the bonds and the treasury bills essentially go up. And this is beneficial for Almasi fixed income fund, which, as you can remember, is majorly fixed income bonds, a bit of treasury bills. So as the yields go down, the portfolio valuation goes up. And also as the yields go down, we also find a lot of trading opportunities in the secondary market because, as you can remember, our Almasi fixed income fund is an actively trading fund. So as yields go down, we find a lot of trading opportunities, so the valuation goes up. And also in the same spirit, as the yields goes down, you also see that investors, they tend to divest from fixed income products more and jumping more into the equities market because they are looking for better returns in the equities market. Because as you can see, since the beginning of the year, we've seen a rally in the Nairobi Securities Exchange. So as these investors go there, our Thamani will essentially go up because of increased activities. And also the earnings season has been very positive. There has been high dividend payout. And as in the coming up, there is an upcoming IPO, initial public offering, whereby NSE, Nairobi Securities Exchange, is looking to welcome the Kenya Pipeline Corporation, and this will increase trading activities in the Nairobi Securities Exchange. And as this continues, we'll see more activities and trading opportunities for our Thamani Equities Fund as well. Yes, so to answer your question, the outlook is still positive for the two of our funds, and our investors out there, just add them to be, it's a time to be excited for positive things for a very good future. Yes, back to you, John.
Thank you very much. So essentially what you're saying is that in as much as the rates in the fixed income space are going down, there are opportunities for funds like Almasi, which are trading in the secondary market, but also like Thamani, which is an equity fund.
Yes, John.
All right. Thank you so much. Maybe we move on to Victoria. Over outside the Nairobi Securities Exchange, Avocap has an Africa Equity Special Fund. It has been one of the outstanding funds for the last couple of months. Maybe you can tell us, why did Avocap decide to create that fund, and probably why is it denominated in the South African rand?
Thank you so much, John, for the question. It's true, the Africa Equity Fund has been one of the highly performing funds for Avocap. It's returned 61.14% up to September. That's since inception in June, at 52.26% for the last 12 months up to September. And the reason why we decided to come up with the Africa Equity Fund is because we saw a gap. Because if you look at the NSE, as my colleague has mentioned, it has only 63 listed companies. And even if you go to the telco sector, it's just one company. If you go to the bank, it's just about 10 companies with an investment. But now we decided to give our clients that regional diversification, currency diversification, and even asset class diversification. Because as we have seen, the African economies have been improving since COVID, post-COVID downturn scaling. Because, for example, if you look at Ghana, which reported in 2022, it is coming up. We've seen inflation coming from highs of 2% in 2024 to 9%, and also improvement in terms of even the economy itself. Also looking at a country like Egypt, its inflation has gone down from highs of 30 in 2024 to current levels of 0.7%. So we created the fund to give clients or investors out there the opportunity to participate in the growth of the fund. Because these are a lot of focus opportunities to be in. And also, if you look at African economies, the main problem is debt repayment. Because, for example, Kenya for the last 3 months, we collected about 583 billion, but 5 or 6 billion of that went to debt repayment. That's around 2%. Means for every 100 collected, and is debt repayment. But if we as Africans in the diaspora, and even everyone who believes in the growth of the African continent, participate in the capital markets, we can grow our capital markets, and instead of going to seek funds, grants, we can even do our development by seeking funds in our capital markets. So ideally, it's a fund for the African growth story and diversification for our clients. You mentioned about the ZAR, reason why we
it's dominated in ZAR.
So if you look at the continent, South Africa is the leading economy in the continent with a GDP of around 4.6 billion. Kenya, we are at around 124 billion. Number $6, $8, thank you. Number 6 in the continent. So South Africa, even in terms of exports, it's in 2024, 19% of the exports were from South Africa, outside of the continent. So it's the best. Even the ZAR itself is one of the most stable. Did around 6% in the last 6 months against the USD appreciation. So that's why we decided to go that, because that's where the opportunities are, and even the stability is. And even in terms of capital markets activity, South Africa controls about 70%. Yeah.
I love what you said. It's the fund for the African growth story.
Yeah.
So that the continent is not growing and we are not having opportunities to grow. So yeah, that is for you, our listener. The Africa Equity Special Fund is the fund for the African growth story. Thank you so much. To my other panelists, I know we have quite a number of opportunities outside Kenya, outside Africa. One of the standout performing funds for Avoca is the Multi-Asset Strategy Fund, a dollar-denominated fund. It's done over 49% the last 12 months. I think you need to tell us where this fund is investing.
Thank you, John. So the key thing that differentiates our multi-asset strategy fund is our thematic approach behind our portfolio construction process. So I'm sure most of you have heard of the buzzword that's been flying around everywhere, AI. And so we do have these various themes we invest in. So one is AI as a theme, one is China as a theme. We have aging demographics as a theme, because as we all know, Europe and some parts of Asia have aging population, so that's one of our themes. We have fiscal spending as a theme. I know EU are increasing their defense budget to meet their NATO commitments. So, so we have all these themes we invest in. Then within those themes, or those major themes we do look at, there's now other themes within this concentric circle that we also invest in. For instance, AI. One data center, for instance, they call them the gigawatt data centers, consumes the equivalent amount of energy as 48,000 households. Now, last year, the Mag 7, so the Magnificent 7 is the 7 largest stocks listed on the US stock exchange. That's your Alphabet, which is Google, your Amazon, your Facebook, your NVIDIA. So last year, this company is committed about $315 billion towards this data center build out. I know yesterday we got most of their earnings coming out, and they did commit to increase their spending by an additional 10 to 15%. So we are seeing spending on this technology increasing by the day. Outside of corporate demand or corporate, you could say, activity within the space, we also have now sovereigns competing for the same technology. The US Department of Defense just the other day announced a partnership with NVIDIA to build data centers. You have Middle East trying to build out their data center capacity. You have Europe and England trying to do the same. So again, as we all know, you don't fight. There's a famous saying that's been popularized in markets. It's don't fight the Fed. But now here we say don't fight the government, because these guys essentially have a blank check. And so when they decide to spend on a technology on a sector, then we do tend to see robust demand. So I think, we have our thematic approach that we use to diversify our portfolio. So one thing we focus on is risk management, where where no individual security makes up more than 5% of our holdings at any given. It's quite an actively managed fund. So I'm sure, as you had about 2 weeks ago, we had US imposing sanctions on Russia's 2 largest energy companies. So for an investor, you're thinking, okay, this is probably time to maybe buy. But on our side, we're trying to think of, okay, what makes Russia unique, as an entity or as a nation? And for us, we come to the conclusion that, okay, Russia, for instance, is one of the largest producers of uranium. Russia, at the same time, is also about 60% of global palladium supply and platinum supply. So we are saying, okay, we've seen the weaponization of rare earth metals from China going to US. So what if Russia now decides to weaponize this same elements or metals and restrict exports? So it's there's one thing they say is it's important to know what's good out there or what's happening, but how you express it is a whole other thing altogether. Yeah, so again, yeah, that's part of our process for the Multi-Asset Strategy Fund.
Thank you very much for unpacking that. So in essence, what you're saying is, some of us, I know, we use, these large language model platforms, ChatGPT, Gemini, and I'm very sure that you would be much comfortable if someone checked through your Google search history than if they checked your ChatGPT search history, because some of us are using it for therapy. But beyond using these platforms, you can invest in them through investing in such funds like the Multi-Asset Strategy Fund. All right, thank you so much. Thank you for that outlook. Paul, let's get from the global markets now home. And one of the most familiar investment products home is the money market fund. And I think many people came into the market last year when the money market was yielding 17%, 16. And now we are doing, markets are at between 9, 10, 11, thereabout. And so there is a misconception, or there is this notion that, the money markets are doing bad, they are bad investments. And yet probably, as you explained in your earlier feedback or explanation, it's the status of the market. So what would you tell those investors who are skeptical, who are wondering what is happening in the investment space? And yeah, how would you tell them from where you sit?
Thank you. So, John, for the money market products, unlike the capital markets, money markets are known for their short-termness. So why they are most popular among the investors is the short-termness, the liquidity. If you want your funds, maybe you can withdraw in the next 72 hours, the longest. So one thing that many people don't know about this money market product is that they're usually the quickest to react to rate changes. So whenever you see the lending rates fall or rise, money markets pick that immediately, because again they tend to invest in short-term maturity securities, for example your treasury bills, and also your deposits in banks, and also your short-term bonds, like the ones with somewhere between 6 months to 1 year, the short-term bonds. So as the yields fall down, the lending rates fall down, the yields on these money markets also fall down almost instantly. Because as you can remember, this is what we call the interbank lending rate. This affects the trend down. We will see from time to time, from the highs of 16% in June 2024, we've seen the yields of these money market products trend down slowly until to a rate of below a single digit percentage. And this one will continue seeing as the lending rate continue to trend down, and as the stability in our inflation rate, stability of our Kenyan shillings, we as Kenyans having like more foreign exchange cover of 5.3% as per today. So as this stabilization continues, we will see further rate cuts, and we will see the yields on these money market products continue trending down. So to answer your question, is not a cause of concern. These